All right, perfect. Welcome everybody. Thanks for joining us. I know it's a long day for you guys. I know you have a lot of topics, a lot of traders such as ourselves giving you our and their perspective on trading and leverage. I think it's probably the most important part of trading. It's what will make the difference between you making it as a trader and you failing as a trader. It's that important. This other stuff that we do off to the side here, the analysis and stuff like that, that's, I would say, one-fifth as important as managing your account properly when it comes to trading. You can be the best analyst in the world, but unless you have the understanding of how to manage capital, how to respond to market conditions, and the way we kind of say it is, there's times when the markets are trading well, and you're trading well. And that's when you really want to get aggressive and get after it and really make a significant amount of money. There's a rule that I learned from trading in the old days, the 70-30 rule, which is you'll make about 70% of your profits in 30% of the time. And those are the markets where everything is working. You're trading well, the market's trading well, and you're firing on all cylinders. There's other markets where the markets aren't trading well, and you're prepared, you're feeling good, you're in a good position, but there's just not a lot of capital to be made. You got to understand when to back away. Okay, and then there's other markets where you're not feeling well. Markets aren't trading well, and it's dangerous. So, that's really the art of the trade, is to understand how to maximize your trading time, maximize profits when they're supposed to be maximized, and protecting your capital. Very important. So, specifically, what we're going to get into is the art of the trade, and that is account risk and trade management. It's a 3-step process. And we're going to focus on the very important part, which is the account side of trading. Specifically today, we're going to be talking about leverage, which is really one of the 3 steps of a complete trade plan. Okay, so risk management, as you know, guys, is very important. A couple high-profile stories that I'm sure you guys remember. I don't know how to pronounce this guy's name, Jackie, and I'll introduce Jackie here in a minute. The professor, as we call him, Jerome Curviel, maybe? He's a French guy, so I wouldn't know what the French pronunciation of that would be, but he lost a cool $7.2 billion, traded at SocGen only a couple years ago. You guys are all familiar with Nick Leeson, who broke the Bank of Barons and was sold for the sum of $1. And then the retail trader, who I consider, on not quite as such a magnificent scale as Jerome and Nick, also a catastrophe, the amount of money retail people, traders, have lost trading. And that's obviously the old story. There's always been trading markets. There's always going to be trading markets, hopefully. So we really got to figure out how to keep the retail trader in the game longer, get you guys making more money, and that is by controlling your account. Okay, so a couple topics, a couple points we're going to hit on today. How does leverage really impact my account? Okay, that's really the operative topic that we're talking about here. How can I guard against account crushing losses? I mean, how many times do you guys trade well? 5-6 times in a row, you make 30-50 points, and then bam, you get whacked for 400 pips. If we were in a room right now, I'd ask everyone to raise their hand who's been through it, and I'd expect every hand to go in the air. So if you're home right now, in the office or at work, raise your hand if you've done it. And then finally, will I be able to trade in a low stress, with low stress and a high degree of confidence? And the answer is yes, you can. You can trade in a low stress environment and trade with a high degree of confidence, provided you understand the process and you realize that there are going to be wins, there are going to be losses, but if you realize how to take those losses as a professional, as a trader who will be here for a long period of time, you'll realize it's just a part of doing business. It's part of trading. You should actually encourage losses because they are small. They've been accounted for ahead of time, and it's the only way that you can get to being a profitable trader. Okay, so who are we? I'm Todd Gordon, founder of TradingAnalysis.com. I been around the FX business for quite some time. You guys may have seen me over at Forex.com. I was the senior technical strategist and trader on the parent company's hedge fund. I've been on CNBC's, actually CNBC's only FX show. I was the technical analyst for the show Money in Motion. And then with me is the Professor, Jackie Fogg. Say hello, Professor.
That would be the good-looking one on the right. Is that the one you're referring to?
Absolutely, the one with an IQ of 180.
Jackie, I'll give you to everybody, because it's 1:07 in the morning here in Sydney at the moment, and this was an important presentation that we've stayed up for specifically. So yeah, we're looking forward to it.
Absolutely. A little background: Jackie's been a trader for a long period of time. He's been through the learning curve of a newer trader. He's progressed very nicely. I actually found Jackie as an excellent Elliott Wave analyst. He was posting charts in our chart room in the discussion forum at our website, and I saw this gentleman doing better Elliott Wave work than I was, and I said, boy, I either have to throw him off the website or hire him. So I was lucky enough to get Jackie. He's now our director of research. He's based in Sydney, and he has a lot to share, both from the trading point of view as well as the analysis point of view. So Jackie's been through it. I'm looking forward to hearing Jackie's presentation back half of the session today. But Jackie will be here, and hopefully we want to make this conversational. So not just a lecture. Nobody likes a lecture.
No.
So with that being said, guys, if you have comments, questions along the way, go ahead and drop them in the chat window. If they're relevant to the current slide or whatever the topic we're on, we'll jump into them. As I just said, we want to make it conversational and enjoyable. So we're talking about leverage. And if you don't recognize that sharp-looking man, that would be Dr. Evil from Austin Powers. And I think leverage is... kind of like Dr. Evil, he's actually not all that evil. He tried to blow up the world, and he tried to hijack the world for $1 million, and he's not all that evil. And I think leverage is actually kind of incorrectly associated with being evil. So Dr. Evil is actually a pretty nice guy. He was a nice father to Scott, and leverage. Those of you who watched Austin Powers.
Let's just say he was misunderstood. I think misunderstood is misunderstood.
That's it. He's lost. He didn't know how to apply his talents. Okay, and and leverage is actually very similar. I know I'm kind of reaching that analogy, but leverage is something that is very important. It's not all that evil, and we need it in FX. And here's why. So here's a chart of euro on the daily. Below it is an indicator I love to use, ATR, average true range. Basically, it gives you the high to low, taking out gaps, which don't really occur anymore, especially in FX because it's a 24-hour market. But it basically gives you the average high to low range for each bar of the chart you're looking at. And this is a daily bar. So you can see the indicator right now is up around 0.0078. All right, and if you guys know your FX quotes, you know that's about 78 pips. So this has increased as euros really dropped here. Volatility expands, range expands. So what I did was use an average level here of about 60. So what that's saying is on a given day, euro will trade 60 pips high to low. And if you divide those 60 pips by the current rate, 28.71, right there in the euro, you get a movement of about 0.5% a day on average in the euro. Okay, and if you use the current ATR, even with today's volatility in euro, maybe it's up around, I don't know, 0.55, 0.60. It's less than 0.75%. If you compare that to Tesla, the stock, which was volatile, but really isn't that much. It really isn't that volatile anymore. I'm using an average ATR of about 8. Okay, and that's $8. If you take $8 and divide that by the current price of Tesla stock, you get 3.1%. So if you compare 0.5% to 3%, that's the reason right there why you need leverage in FX. It's required. It's definitely not evil. It's required. Euro moves about, 1/6 intraday in terms of percent that Tesla stock does. So you need leverage. Okay, so let's go right into this, and let's talk about exactly what leverage means. We're going to start with two trades. Okay, trader one, who's going to put on a trade, Joanne. Joanne has a $10,000 account. She's trading 2 mini lots, and she's very, very conservative. She trades at 5-to-1 leverage.
I like Joanne. That's good.
You like Joanne? That's your
style.
Yeah,
she's conservative. I like that.
It's not a J thing?
No.
Jackie, Joanne? Okay. She's conservative. So she's trading 5-to-1. So that means with a $10,000 account, trading 2 mini lots, and a mini lot, I'm kind of from the old school FX, which I know today's brokers have all kinds of different lot sizes. A mini lot is equivalent to 10,000 notional. So actually the dollar sign shouldn't be there. If we're trading euro, it's 10,000 euros as the base currency. So, okay, fine. So 5-to-1 means if you have a 10,000 notional position, you got to have 1/5 of that on hand as margin, as leverage. Okay, 5-to-1 is very conservative. So 1/5 of $10,000 is 2,000. She's trading 2 minis. She needs 4,000 in margin. Okay, $4,000 in margin to control 2 mini lots. Okay, that is the opposite of leverage. Okay, that is being very conservative. So she goes to put on a trade, buys 2 euros at 130, places no stop. Okay, she's kind of like this guy who is just dreading, never put a stop in, absolutely getting crushed on the trade, finally panics out. That could be Joanne right there. That looks like a woman right there. Finally closes the trade at 125. Okay, so she has a $1,000 loss, or 10% of her $10,000 account. That's trader one. Okay. Now, trader two, Warren, has the same size account. He's going to put on the exact same trade, but he's trading 2 mini lots, same size, 2 mini lots at 50-to-1 leverage. Okay, let me go back. Joanne was 5-to-1. Warren was 50-to-1. So his two mini lots, or two $10,000 lots, requires $400 in margin. Okay, so if you have one mini lot at 50-to-1, you need 1/5 of that, or 1/50th of this size, which is 2%. You take 2% of 10,000, that's $200. So he has 2 lots on, so you need $400. Puts on the same trade as Joanne. Buys 130, places no stop, finally panics out at like 125, and he loses $1,000 or 10% of his account. So what's my point here? They both lost $1,000 or 10% of their account. It took Joanne $4,000 in margin or leverage, which is what we're talking about, to lose 10% of her account. And it took Warren $400 to lose 10% of his account. What's the point here, guys? The point is, I think this whole leverage is evil thing is completely inaccurate and completely misunderstood, like Dr. Evil. Okay? It doesn't matter how much money your broker makes you hold in margin to secure an FX position if you have no trading plan. I don't care if you trade 200-to-1. Okay, if you have the proper plan, leverage is meaningless. That's why I kind of feel like the whole day's topic of leverage is kind of, let me close my email so you're not getting, is kind of, it's a little bit of a waste of time, frankly. If you don't have a plan, okay, and you're not trading with stop losses, I don't care how much money it takes. You're going to blow up your account anyways. You're down 10% whether you took 5-to-1 leverage and was conservative, or 50-to-1, and you still lost 10% of your account. Okay, so the most important thing with guarding against a retail trader's account and any trader's account, not even retail, Jerome at SocGen and Nick Leeson, is to have an understanding of what you are willing to risk in a trade before you go in. That's the only way you can control risk in trading, is to understand what you're willing to risk before $1 or euro 1 or yen 1 goes into the market. That's it. Okay, trading is an emotional game. You put on a trade. I don't care what amount of money you have involved, you will start feeling that emotion in yourself, and that is not the time to make the decision to decide how much you want to risk on a trade. The time to make the decision of how much you want to risk on a trade is made before the trade begins. And this right here, what I talked about, this has nothing to do with your success as a trader or your failure as a trader. It has everything to do with whether you are a planned trader or not. So that is a lead into the three-step process that we employ in every single trade that we do here with clients. And that is a lead into plan my trade, trade my plan. Nathan, couldn't agree anymore. What a great comment he makes. Pending orders help me with this sometimes. That is such an intelligent comment. And I actually monitor myself quite a bit on this. When I find that I'm trading more at the market, and Jackie, tell me what you think on this. When I'm trading more at the market and not putting limits out there, I think I'm reacting and not anticipating enough. Okay, I always know how much I'm going to risk in a trade. Always. I mean, I just learned that from way back. But when you're trading on limits, meaning putting I want to sell at this price, or I want to buy at this price, and then have a stop loss in there, you are thinking as a pre-planned trading. You're in fact planning your trade and trading your plan, which is the logo or the motto of our company located in the logo. So just a quick story, and then I'll turn it over. As opposed to taking a trade in the moment, which I do sometimes more emotionally. So let me tell you a quick story. It's a great point you make. Before I was a retail trader, I was an institutional trader, and I traded for a hedge fund at Gain Capital. And it was pre-credit crisis. It was upwards of $100 million in capital. It was me and 8 other traders. And the way it worked out was, people would say, well, how'd you do this month? And you say, what percent were you up? You say, well, I can't really answer that because the way the fund was set up was we had risk capital. So in 1 month, the CIO, the chief investment officer, came to me and said, Todd, based on your trading, based on your statistics, you have a risk limit of $100,000 this month. That means I could risk $100,000 that month, and that's it. If you go over that risk limit twice, you're fired. You're done. You lose your job. So I learned very quickly how to control capital because I knew how much I could lose in a month. Basically, it didn't matter how small or large I traded. I had to know before you get into a trade. Let's say I wanted to do a massive position. This was before when I was trading OPM, other people's money. If I wanted to risk $25,000 on a trade, okay, then I know I would need to trade, let's say, 3 million euros with an 80 pip stop, which is about $24,000. So kind of working that way backwards trained me to think in terms of how much capital you're risking. Okay, but to your point, and then you guys may have known me from Forex.com where I wrote Strategy of the Day. I would basically take the trades I was putting in the hedge fund, write about them in Strategy of the Day, and publish them out to everyone at Forex.com. And so the only way I could really write those trades, get them in an intelligible format, have them be actionable for readers was I had to trade on limits and give people time to put orders out there and say, if Euro gets down 40 points, buy them here, put a stop there. So that's actually how I then learned to trade on limits rather than market, being forced to write the daily research report that went out to 40 countries around the world. We had to give people around the world time to read it and be able to benefit from it. So the combination of those two things really kind of led to where we are today. So good. Yeah, no, great feedback, Nathan. How long have you been trading? I'm curious. I'm wondering how long it took you to figure that out because it's really good. And while you're typing, I'm just gonna keep going so we get the professor in. Okay, 4 years. Good. Well done. So we have a 3-step process, and we're going to focus on the 3rd step right here, which is account. Number 1, intermarket analysis. Okay, we always like to know, if we're trading FX, we always want to know which market is going to impact FX. FX right now does not trade alone. It hasn't traded alone for years, and it really hasn't ever traded alone. The S&P is going to have a big impact on where the yen is going. The U.S. bonds are going to have a big impact on where the yen is going. Crude oil is going to have a big impact, and Brent is going to have a big impact on where Norway's going. What's interesting with this Scotland vote, if they actually do go out on their own, they're actually a major oil exporter. So whatever currency they wind up with could be, if they go to their own currency, which I don't know what's going to happen, but it could be very much correlated to oil because they're a major oil exporter. So you got to know which non-FX market is impacting your FX trade. Number two, we go into pattern recognition. So we go into the Elliott wave analysis. We do traditional technical analysis. We do a lot of Fibonacci. And we found that Elliott wave and Fib allows us to plan your trade your plan, because there's points at which the trade will work. There's upside targets. There's points at which we no longer want to be in the trade, which becomes your stop loss. For the person looking to control emotion and trade ahead of the market, there is no better methodology out there, because it allows you to be a pre-planned trader. Is it perfect? Does it work all the time? No. It works, I would say, slightly better than 50%. But when you can risk X to try to make 2 or 3X, and most importantly, you know you're going to risk X to make 2 or 3X 3 to 4 to 5 hours ahead of the time, before the trade ever goes on, you're ahead of 90% of the other traders in the market, and you won't make one of those big emotional mistakes. Final step of the process is we send the trade alerts out to clients. For example, sell at market, which we don't often do. This was just a half a position. This is one of our trade recommendations. Stops here, targets there, see trade desk for more information, lower your stop loss. That is real account management. And part of the part that we really want to focus on here is this tiering system. Okay, understanding when to get aggressive and when to not be aggressive. Okay, so I'm going to touch on this real quick. Basically, as we trade with clients, and I highly recommend you guys do this, rank your trades. Okay, I think 4 is good. You could go down to 3 if you like, but have a ranking. Tier 4 is our average everyday trade. Okay, we're just getting involved. We want to see what happens. Tier 3, a little bit more aggressive. Tier 2, maybe a couple of those trades a quarter. In Tier 1, I haven't done one of those in over 2 years. Those are the highest conviction. I mean, everything is lining up and you want to go for it. You have to fluctuate your size. Okay, the best traders that I've learned from, guys, I've seen them trading a couple standard lots just in and out up to 20 to 50 million when they're really trading well. That's how much they vary their position size. So really vary your size depending on how well you're trading and how well the market's trading. Okay, so the tiering comes with a percent risk that you're going to put on before every trade. Okay, the average and the more conservative, I would say, investor, anywhere from 0.5% at the lowest up to 2% at its most aggressive. I'd say Jackie and I are probably over here, right, Professor?
Correct.
Yep, you're not, and Jackie's going to talk about this. He's not comfortable risking more than 2% of his capital. Jackie trades a pretty large account, so that comes into it. Those of you who trade, moderate size accounts and smaller accounts, you might be forced into these more aggressive percents, because if you want to trade a couple mini lots on only a $10,000 or $5,000 account, you're going to be forced into this aggressive trader profile. So just keep that in mind. But the most important thing is to decide what are your percent risks before every trade goes on. Okay, this was the most recent trade that actually we still have on, which, where's Euro right now? Where is Euro right now? 07. All right, a little strong. We're also short Aussie, which is good. Okay. So this is a trade we have on right now. We actually took it through the Fed. We sent it out on the 15th, and this is an example of how we set out the trades. Okay, so we did a half of a tier 4 euro at market, stop, 2 targets. Basically, guys, we have the entire trade planned out before anything happens. Okay, a lot of times we'll sell on a limit or trade at a limit away from the market, but this just happened to be right at the price we wanted to sell. Okay, so here's the setup. We took it in pre FOMC, moved down. We're coming back in wave 4 as I just showed you. We're going to manage the trade and hopefully get down to our target. So this whole concept of tiered versus raw pips, this is a track record of our research business from 2011 to 2012. Basically, it shows if you traded the same amount of lots every trade, that's what you did in pips. If you fluctuated your size based on our tiering system, telling you when to get aggressive and when to stay conservative, your performance was more than double through 2011, 2012. So point here is size fluctuation is very important depending on market conditions. But again, guys, the point of all this is it doesn't matter how much capital it takes to hold a position, provided you know your stop loss before every trade goes on. That's how it doesn't matter. You could trade 200 to 1 leverage, and you can trade as a very smart and conservative, but yet aggressive trader who will make it for the long run. So I'm going to bring in the professor here, and he's busted my chops for years. He says, Todd, this PIPS thing doesn't make any sense to me. Okay, performance doesn't mean anything. What does that mean to me for dollars? And it used to kind of annoy me, but he's absolutely right. So he's made me kind of redefine the business and our reporting, which I think is completely necessary. And I'm totally kidding, Jackie. We're going to go down a new path. We're kind of reinventing the way we report results, because I don't know about you guys, but a lot of people that we in our space say we made 3,000 pips this month. What does that mean? What does that mean? It doesn't mean anything. So we are going to show you guys a new way to kind of report results with the professor, and I think it's a very fair, a very equitable, and a very transparent way to report results, which I encourage you to do on your own trading. Come up with your risk profile. Follow this formula that the professor is going to give you, and you're going to see your trading improve. So, Jackie, I'll turn it over to you.
Okay, I thought you were going to say that caricature of a professor is a very fair representation of me. I'm pleased you walked away from that, so that's fine. But just very briefly, that is a point that a lot of people will argue against. They say, well, you don't really know which trades are going to succeed and which ones are going to fail. Therefore, every trade should be put on at the same size. Well, as Todd says, we do strongly disagree with that. There are times that markets are, for example, trending much more clearly, and there are times where markets are purely overlapping and confusing. So there are times when you believe, based on markets and correlations, that you do have a better chance of a trade succeeding, and therefore not having every trade the same size is important. And the proof of the pudding, of course, is what Todd showed with the previous chart. By changing the size, you can end up with a better result. But enough of that. Back to the point that he raised. And it's not so much that people who report results, and we'll switch to the slide because you've got control of this, Todd, and I'll let you press the buttons because, yep.
And grab me. I'm going to be answering questions on chat here as well. So
I'll grab you.
Yep. So
if you fall, well, I'll politely yell at you. The question, of course, is how are results reported? And the two most common ways of reporting results at the moment, and has always been this number of pips. We made 150 pips this month. We made 200 pips this month. And it's not so much that the number of pips isn't a good way to report it, but it's just that we find from experience by talking to people that a lot of people don't instantly see the correlation between, okay, well, I made 100 pips this month. Okay, we're all clients. We all made 100 pips this month. How much did my account go up by? Did it go up by 1%, 2%, 3%? How much did it actually go up by? And a lot of people seem to have trouble, therefore, taking that number of pips and then turning it into something useful. What most people understand is, okay, if the number of pips is positive, we must have made money. If the number of pips is negative, we must have lost money. But that's not enough. It's a bit like going to your accountant after 12 months, and your accountant says, well, how did you go this year? And you give him a shoebox full of receipts and say, well, mate, you work it out and let me know. Got to really know a bit more accurately as you're going, not at the end of the year. So yep. Number of pips is one way of doing it. The other way we see people doing it, sorry, go back, please, Todd. I know you want me to finish quickly, but
that's okay. Sorry.
That's all right. The other thing that some people do is show you an equity curve. And here on the screen is an example of an equity curve. And they say, well, look, we start with $10,000 on this date, and you watch how the value of the account rises. Well, all that's good and well to every client who started trading on that day when the first trade was put in at $10,000. If you joined 3 years after that, you don't really instantly know by looking at the chart how your account is progressing. Obviously, you can tell if I started on the 10th 98, okay, it's gone a bit higher or it's gone a bit lower, but it's not giving you a good answer. So the question is there a simpler and easier way? And we'd like to suggest that there may be. Please change.
Got it.
Okay, and so we've discussed that they're confusing, it's not clear how much the account changed and you joined too late. So the new idea we want to suggest is instead of reporting on pips, we want to report each month or each quarter or each year, not by pips, but by tokens. I know the picture in the bottom right-hand corner looks like a gambling chip, and I know a number of people associate gambling to trading. If you do that, then, blowing up an account is something that will happen a lot more quickly. But let's discuss this concept of reporting results by tokens. Change, please.
Okay.
Before we do, there's one important concept we need to get clear in, and that is the concept of risk-reward. Risk-reward's a very important concept. What it does is it compares the number of pips you risk in a trade against the number of pips you're trying to make or you actually make. So, for example, if you were to buy the Swiss franc at 94 cents and you had a 20 pip stop at 93.80 and you're trying to make 30 pips, 94.30, then you are risking 20 pips to make 30 pips. And what's important in that is that you try and make at least as many pips as what you risk, preferably more, preferably even a multiple. But at least every trade should be going in with the idea of trying to make at least as many pips as you are risking. Now, what's interesting about that is it's called risk-reward, but the way it's calculated as reward-risk. So if we go back to the example of we risk 20 pips to try and make 30, we actually divide the 30 by the 20 to get 1.5. And you want the risk-reward number to always be at least 1, preferably a bit more. And the other thing is you have to base it on where you actually exited a trade. You can't say, well, I'm going to attempt to make 100 pips. Aren't I brilliant? It doesn't matter what you attempt in life. It's what you achieve in life. And if you only actually make 30 pips, then the risk-reward is based on not your theoretical, but on your actual. But your theoretical is important as part of the planning process. Next, please. So, Now that we believe we know what risk-reward is, let's tie it into the concept of tokens. We want to go back to Todd's two traders from earlier on in the presentation. He had Trader Joanne and he had Trader Warren. Earlier on, he had them trading both $10,000 accounts, but we'll imagine that for some reason, Warren ends up with a bit of a windfall, and so now they're not trading the same. So on the next slide, we'll see that the account size that Joanne is trading is a $10,000 account, and Warren's trading now a $1 million account. Well done, Warren. And going back to those risk profiles that Todd showed earlier in regards to the conservative trader, the aggressive trader, each trader is going to trade a different percentage of their account on each trade. Now, as Todd also said, if you're trading a small account, it's a bit hard to be conservative. Otherwise, you're really not going to be in much of a position to take many trades. So typically, a $10,000 account should be looking to risk 2 or 3% at a minimum. Otherwise, you're really not going to be able to take trades. So let's assume Joanne risks 3% of her account balance on every trade. And Warren, who is the conservative type, and because he's got a lot more money in his account, he's not going to sit there and risk 3%. He's going to risk 0.5% on each standard trade. There'll be trades that he thinks are eventually better than average, and he'll risk a bit more on this, but we're talking about the majority of trades and what do they risk. So now the question is, what is the value of the token to Joanne? And on the next slide, we'll see that the value of the token to Joanne is simply 3% of 10,000, which is $300. And in Warren's case, it's 0.5% of $1 million, which is $5,000. So on the next slide, what that translates into is that when Joanne trades, each trade she's effectively putting down one token, and that token is worth $300. And when Warren's going to put on a trade, he's also going to put down one token, but his token is worth $5,000. So if both Joanne and Warren were clients of the business, and we recommended that they take that recent euro trade, they would both be risking one token, but the value of Joanne's token would be much less than the value of Warren's token. Okay, so each person has a token, and the value of that token is impacted by their account size and what they're prepared to risk. Question still is, how does that token concept have anything to do with the results? Well, on the next slide, we have a situation where under the value of token we can say, well, we didn't make 120 pips in September, we made 2.5 tokens. So if we say that we made 2.5 tokens, that number has to be meaningful to both Joanne and to Warren. And it actually is. Because if the value of Joanne's token is $300, every trade she risks is about $300, and she made 2.5 tokens this month, and she can simply multiply 2.5 by the value of her token, $300, and she's made $750 in the month. And on the same basis, Warren can also take the 2.5 result and multiply it by his token value, his typical amount that he risks on each trade of $5,000. He gets $12,500. And it may be the next month, the result was a loss of 1.5 tokens in the month. And that equates to minus $450 for Joanne and minus $7,500 for Warren. So if we explain the result of trading as a single number of tokens, like 2.5, now the question is, how do you get to 2.5? How is that calculated to get to that result? And that will be explained on the next slide. There is a formula to explain how you calculate the tokens if the trade works and how it fails. Like a lot of formulas in life, formulas I find messy, complicated, and people don't remember them anyway. The easier way, in my opinion, for people to understand this is to see a numerical example. And we're going to skip the formulas and go straight to the numerical examples because I like them much better. Now, there are 4 examples, and the first example is doctored. It's not a real example, but it's done just to be able to explain the concept. This is a spreadsheet that we use which has each of the trades, and each trade, there are 4 trades on this screen, and the first of which is the dollar franc trade. It was a long trade. We entered at 92.50, so we bought the Swiss franc at 92.50. We put down our token, 92.50. Our stop was at 9200, so we are risking 50 pips. Now, if you're Joanne and her token's worth $300, then this, which is a 50 pip trade, she would be out there trading 6 mini lots, and that would be her $300. Warren, on the other hand, well, he's trading a lot more mini lots, and he's probably not trading mini lots. He's probably trading standard lots for his $5,000. So, but in both cases, they're trading a token. Now, the aimed exit for this trade is 93.75, and as it turns out, we achieved 75. And so we got in at 92.50, placed a stop at 9200, and we got out at 93.75. What does that mean? We risked 50 pips on this trade, from 92.50 to 9200. We made 125 pips on this trade, which is the 93.75 less the 92.50. So if we made 125 pips and we risked 50 pips, we can calculate the risk reward, which we discussed a moment ago, as 125, what we made, divided by what we risked, 50 pips, and that's 2.5. So on this one particular trade, we made 2.5 tokens. We all made 2.5 tokens, irrespective of the size of our account and the percentage of our risk. We all made 2.5 tokens on this particular trade. Now, for the sake of equity, not every trade succeeds. In fact, the majority, probably 50-50 trades are losing trades. The next one is an example of a losing trade. We went long euro-yen. We got in at 137.65. We had a stop at 136.45, and we got stopped out at 136.45. It happens. So what have we lost? Well, we've lost a token. Our trade failed. We put down a token, whether we're Joanne, whether we're Warren. We both put down a token at the start of a trade. We put down an entire token. The trade failed completely, meaning we got stopped out where we put our original stop. So we each lose 1 token. So now after 2 trades, we were up 2.5 tokens on the first trade, down 1 token on the next trade. We're up net 1.5 tokens. And you can continue that procedure for more and more trades in the month. And at the end of the month, you would simply add up all the pluses and minuses of your tokens, and you would end up with a number of tokens that you've made in that particular month. And therefore, the meaning of that, there is some relevance. Now, let's move away from this theoretical example, and let's move to the next slide, which contains actual trades that we're currently taking. This is our current spreadsheet, and the bottom 2 trades are our 2 active trades, our Euro short and our Aussie short. The prior 3 trades are the last 3 trades. And what we'll see there is that we sometimes don't even risk an entire token. And that happens in normal trading. Even though the value of our token may be $300 or $5,000, we may decide to put half in at this level and half at another level. We'll say, look, we'll go half at this level, and if the price moves in our favour, then we'll risk another half. Well, if the price doesn't move in your favour and you get stopped out, you've only risked half a token, so you've lost half a token. I heard breathing. I wasn't sure if you wanted to jump in and say something.
No, I'm here. And what I wanted to do was just try to pull it back. What is the underlying the underlying point of the token is we have a fixed dollar risk, right, Jackie?
Correct.
We know exactly what we're going to risk. So a token is in fact worth a certain amount of lots, correct? So a token is you will know what a token is worth in the amount of lots going in. So you know what your trading size is, correct?
The token is basically a monetary value.
It's a monetary value. So I think then it's important to pull it over to this, which is the calculator. Okay, this is on the site, and let's just take it through. And I know we're bumping up on time, but let's do, for example, the most recent trade we just did. Okay, so let's go to Euro, and we want to show you exactly how to calculate your appropriate size, and then we will finish up. Where is that Euro trade we just did? There it is. Okay, so we're doing half of a tier 4 Euro at market, right? So let's do Euro. We're going to go short. You're going to do a 4. We're going to do 1/2 of a position. And we're in at what price? 29.38 and stopping at 30.17. 1.2938, and we're stopping at 1.3017. Now, guys, I have this pre-populated with a $10,000 account, and you'll notice that we have the medium risk profile in there, 2, 3, 4, 5%. It's actually a little bit different. It's 3, 4, 5, 6%. A little bit more aggressive. That's fine. So this is the most important process to go through to calculate what your tokens are going to be worth. So if you have a half a position, here's the entry, here's the exit. I'm doing a tier 4. Tier 4, I'm going to risk 3% of my account. Have a $10,000 account. Recalculate. Your max lots available are 4. That is really what you need to go through before every single trade. What we encourage our clients to go through, and that's how you calculate tokens, which then allows you to calculate exactly how you would do at the end of the month and what that account should be worth. Is that kind of a good summation, Jackie?
Sounds good to me.
Okay, perfect. All right, guys, just a couple minutes over, so let me just give you the quick rundown here, and then I'd like to take some questions. If you guys want to come over, we're at tradinganalysis.com. The professor and I run the session. Jackie does overnight, based in Sydney. I do in the New York session. You have access to the chart room, which we've shown you. We do a daily video every single day. Obviously, as the name implies, you have access to the trade desk to show all open positions. You get access to everything shown here, SMS, discussion forums, webinars, different options, and some of our partner broker firms have special deals for our clients. The position calculator, our Elliott Wave download, there's a lot involved. So you do have questions, go ahead and hit us at tradinganalysis.com. There's a phone number, that's Rosa, she would answer the phone, info at Trading Analysis. So go ahead and give us a try. We do a 30-day trial for $7 if you are interested to jump in to see us handle these positions. So guys, we're here if you'd like to answer some questions. And yes, so FX Boyke is saying, let's see, what is safe? Okay, actually no. FX Boyke, let me know what you mean by that. I want to be sure that you understand that percent safe leverage. Nathan, just curious, some of the factors that help you decide what tier level to grade a trade. Okay. It's interesting. It has to do with the ART, account risk and trade management. It's really all three steps. It's how well markets are correlated to other markets. It's how good the pattern is. That determines how aggressive we're going to be. That's something that takes experience. And I showed you the chart of our wherever it is, our performance on a consistent position size versus adjusting your position size based on how good we judge the market to be. It's double. So it's a skill game. It's something that will take you time and effort to be able to judge when a market's trading well and when it's not. So hopefully that makes sense. What leverage do we recommend? Christian, I don't know if you were here in the beginning of the presentation, but my whole point was, based on this example, whether you're trading at 5-to-1 leverage, which is 20%, or 50-to-1, which is 2%, it's meaningless. It doesn't matter, because all of you should be trading with stop losses, which is part of the three-step process, which comes with every single trade. So it doesn't matter how much money, what the leverage is, percent risk. If you're risking, for this trade, if you're selling at 89.65 and you have a stop at 20, you have 55 pips of risk. You've then got to take that, plug it into the calculator, and say, okay, if I have 55 pips of risk in Aussie, right? Aussie USD, let me just, I don't know what the numbers are, but let's just say we're going short at 0.9055 and we're stopping at 0.90 for 55 points of risk. And I've determined that it's a tier 4. I'm only going to risk 3% of my account. It's a $10,000 account. Hit recalculate. I did something wrong there. It's 5 lots. I had something switched there. But anyways, it's 5 lots. So it's the fact that you always have a stop loss in place to know all I want to do is risk 1 token, which is $300 on this trade. So if you wind up having 5 lots, I don't care how much money from your account is required to secure those 5 lots. I don't care if it's $5,000 or $500. The only thing that matters is the net impact if this trade were to be stopped out. If this trade were to be stopped out, you would lose $300 and your account value would be $9,700 now. So that is very important. I don't care if it costs $1. I don't care if you trade 1,000-to-1 leverage. Guys, I can't stress this enough. I really was hoping you guys would pick this up. I don't care if it takes $1 to hold a mini lot and you're trading 1,000-to-1 leverage. The only thing that matters is how much capital you're going to risk if the trade plan does not work out, and that if it doesn't work out, and that's why you need to plan your trade your plan. Okay. Do you like to take partial profits and still let your positions run, or enter a trade again? I love both of us, Nate. Great questions. Both of us love to take partial profits. it's hard to, and I'd be curious to know what you think, Jackie. It's hard to give up your position. Okay. We are short euro right now based on this count, and we like to trade multiple units and take profits on the way down. It's hard to re-enter a trade because your entry point, which we have up here, is all of a sudden going to be much lower as you're selling lower. So you give up your position of strength. Okay, so we like to, rather than trading in and out, we like to trade with multiple units and scale out on the way down. That's why a lot of the platforms these days, it's really nice that you can trade outside of just a $10,000 or $100,000. You can trade in any amount you want. So if only you're trading $5,000 or $10,000 position, you could scale out in 4 or 5 different points, which is excellent, and that's the way to trade.
You covered it well. If you could scroll to which had our most recent trades, we can actually illustrate that that's precisely what happens. Only because I don't remember the numbers. Excellent. Whoops.
Nope.
Let's go back a few.
Yep,
that's the one. Okay. So if we look at that one, for example, you can see that for the first trade, dollar CAD, we got in at 109. We had a single stop at 108.35, but we exited half at 109.53 and a half at 109.96. And then on the second trade again, there was a single entry, but we had 2/3 of an exit at 91.27 and the remaining third at 91.50. So we do like to scale out, and for the 2 trades that are currently running, we have the same sort of situation.
Yep, exactly. Christian, mini lot or standard lot account, I would say if you have less than this is going to be conservative, if you have less than a $50,000 US dollar account, you should be trading minis. Anything above 50,000, you should be trading standards. It's just the value of having multiple units can't be stressed enough. One final, and I know FX Street is going to throw us off. I apologize. I was trading, as I said, I traded for a fund, and I would have my risk limit per day or per month, and I would be trading large size, $5 million, $10 million, $20 million positions, but I was not really making any money. I was getting stopped out a lot. It's not until I scaled my size down by a lot to 5 million, 1 million, even 500,000, stretched the trade out, had multiple lots, had room to work in the trade when I really started making more money. I was making more money with smaller size rather than really jamming myself up with big size. So the point is, trade small, trade with multiple units, and that is going to give you guys the breathing room. It's going to give you the clarity to go through the 3-step process of plan your trade, trade your plan, 3-step process, which is up here clearly, and that's what you want to do in trading. What needs to happen would push euro to 132.50, which is impossible at the moment. I don't know. It's the Scottish vote could definitely bid up sterling, but I think this is more of a euro market. I mean, look at euro sterling on the way down. So euro sterling is whatever. We'll leave that one alone. So guys, great questions. If you have anything else, come on over to tradinganalysis.com. Whoa, Jackie, you're hot rodding it over there.
At 2 o'clock in the morning, that's not unusual.
So just come on over here, guys. You can hit the Join Today button, and you can get all of our research and analysis at tradinganalysis.com. So, guys, thanks a million. Thanks, FX Street. Thanks, Jackie. And hope that was helpful, guys. Obviously, you can tell we take it pretty seriously. This is important stuff.
Okay.
Thanks, guys.
All the best.
See you guys.